Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to be ripping through Twitter, seeing what people are talking about. I'll give you my financial opinions around all the topics we talk about, which are going to be financial related, wealth building, or commodity topics for the most part. Let's dive in here, see what's going on, and see what people are talking about. And if you want to follow me at finding_finance, and if you want to join our website, the community, we have a discount going on at finding-value.com. The discount code is August, and it's the last day to sign up, I think, which is August 15th. So let's go down and see what's going on here. So we've got, how old were you when you bought your first house? Was it a good time to buy? So my first house I bought in 2009, I think. And it was a condo that was foreclosed, and I got it for $106,000. It had 2 covered parking spots. It had a storage area, and it was a 1-bedroom. I got it for that price, pretty cheap, and I did that rather than rent or buy an apartment. And I had that for a couple years. I made $30,000 selling it or something like that. So it worked out pretty good. I'd say it was basically like living for rent free for 2 years. And I did fix it up a little bit. URNM and URNJ still looking solid. We had a little down day today, which is what I consider to be a bloody nose. And URNJ also had the bloody nose. And I was just letting everybody know, hey, look, it still looks all right. Just be patient, guys. Now, someone did make a comment. We can go down here. He says, I would argue almost all of these moves is consolidation and standardization of valuation of spot. I would disagree. The reason I disagree is generally what you get is you get these consolidation. So we're in a consolidation here, but this big candlestick, this big green candlestick, I would argue is the beginning of a potential move higher. And the better investor you are, the better you can recognize those differences and get in sooner. The dead period is this period here, where it was, I call it the dead period, where the buyers equal to sellers. Then you get the big bullish engulfing there. We popped higher. And yes, you could draw this line coming across the closing point here. I would say the breakout was even earlier. I like buying stuff earlier than probably most people. They're going to say, a technical chartist would tell me, that's far too risky. My answer would be, you're going to wait $2 or $3 higher and buy it. And you're telling me that I bought at a more risky time. I buy it when the tailwinds are behind me, and I'm looking at the patterns where this is a consolidation, and they're going to say, well, how do you know it's not going to break lower? Well, I'm fine with owning it even if it breaks lower, because I think that we are in a supply deficit of commodities in general. I think we're in an increasing interest rate environment, which is quite obvious with the breakouts. And then the valuations of all these commodities are dirt cheap. So if I'm buying an asset that's dirt cheap and it's barely just coming off of a basing pattern, which uranium is, oil is, and all these other ones, I don't really see the risk the same as what other people see risk. They see the risk of price movement. I see the risk of bankruptcy or a problem with the company being pretty low risk. So I view risk as bankruptcy and total loss of capital. They view risk as volatility and short-term market movements. I just view it differently. I don't care if I go down for a little bit and we go to 2250 before going higher. Okay, no big deal. I'll just keep buying it. But I don't know. We play a different game, and that's okay. I'm okay with people playing different games. But I'm not a short-term chart trader. Where I don't solely base my decisions off of charts. I need an alignment. I want that alignment where it tries to all align. Ratios is your valuation. So it's your valuations, your supply deficits, your interest rates, all that stuff. And if that alignment occurs, the chart is a function of humans trading with each other. And it's just a consolidation period to me. We're in a much bigger move. Tell me how I'm wrong. Oh, well, it could go down and you drop 20%. I'm like, okay, then what's going to happen after that? So everyone is so afraid of the short-term market movements. They perceive short-term market movements as risk. And I just don't. If your valuation's at your back and the market conditions are at your back, you could get a 40% pullback anywhere within this bull market. And it could be for any reason. But if it's at the bottom of a consolidation, screw it. I'm going in. I'm going to go for it. But that's me. And I understand other people are different. The cost of trying to time the market. And this is also tying with a lot of the charts. The cost of trying to time the market. So we look at this. It says this is value of $10,000 invested in the S&P 500. So invested all days, $65,000, just rounding. Missing the 10 best days, $29,700. Missing the 20 best days, 18 grand. Missing the 30 best days, $11,700. And then missing the 40, 50, and 60 best days, you are losing money. So timing the market, according to a lot of people, they try to time the market. They end up losing money if they miss those really good days in the market. Now, what I do with commodities, if you go up here, I do this. All I do is I try to time my entry points. I'm going to mess up some of my entry points. It's a function of using technicals, which isn't a 100% outcome. It's a lot lower than that. It's 60, 70%, somewhere in there. And then I don't try to time it after that. I just sit in it. And if the ratios and the ratios are your valuations, the valuations are cheap, it's just a matter of time at that point. Now it's how patient can I be? And if I can look over and say, the market's going to move, money's going to start moving and we're coming out of basing patterns, it's just a matter of time. If there's a slowdown or a recession in the market, that is only temporary. That is not permanent. A recession is not going to permanently destroy uranium's market supply-demand balance. It's not going to permanently destroy oil demand, where oil will go down forever. It's not going to permanently destroy the copper demand if copper goes down for 6 months to a year. The valuation is still cheap, and the deficits are still there. Nothing's been solved in the market through a recession. It's only delayed the eventual outcome. So a recent study said that 56% of Americans believe making 6 figures would make them rich. 18% of people in the U.S. earn 6 figures per year. That means over half the population thinks 1 in 5 people are wealthy. What income level do you think makes a person rich? So I don't think an income level is something that defines or makes someone a person rich. When I think of a person who is rich, I think that they are making money in a way that they don't sacrifice their life. There's a lot of people who make a lot of money, but they're not necessarily rich, at least not what they have to sacrifice for it. So I've made not a lot of money, and I've made a lot of money in my life. I've made over 6 figures a year during my life, and there's been times I've made a lot more than 6 figures in my life. And I don't consider myself rich with an income. I don't think income is what defines someone being rich. I would define someone who's rich or wealthy because they use this interchangeably. They say half the people, 1 in 5 people are wealthy. You can earn 6 figures and of income and be dirt poor. And what does that look like? You borrow money, you borrow You're in debt for your car, which is depreciating. You're in debt for a mortgage. You're in debt for a lot of things that you own. So you're making payments. Then, if you could also be poor in time. I know a lot of people who work at the company that I work, and they might make six-figure incomes. They might make $150,000, $200,000. The question is, what are they sacrificing to make that amount of money? Are they working 60-hour work weeks? What is their ultimate dollar pay per hour? And I think that's where you want to be, is you want to maximize your dollars per hour. And the smarter you get is the ability to increase your dollars per hour. So it's the efficiency of making money that matters the most. So when you look at people, there's people that might make $80,000 or $90,000 or $110,000 being an engineer who does an 8 and skate. They work 8 hours, they get out, and they make $120,000 a year, $150,000, whatever it is. That's pretty good on a dollars per hour basis. Then some of these people go into management, and now they have to go from 40 hours to 60 hours, but their pay goes from, so let's say 120, 130 up to 150. I wouldn't say that's necessarily a good bet. He's not really increasing his level of wealth per se. I mean, he's economically benefiting from maybe that situation, but he's dumping time into it, and your dollars per hour dropped dramatically. And your headaches and your workload probably went up as well, depending on the position. Because now you got to worry about a bunch of crap that you probably don't want to worry about. I call that stress. Stress is something that you worry about but don't care about. Passion is something you care about and you don't stress over. So I would say if you can find something you're passionate about and you can really increase the efficiency of how much money you make on a dollar, like a per hour basis, I think that's really where wealth can be created on multiple scales. Wealth can be created from economic means, and it can be created from an hourly, time perspective as well. And those who get incredibly wealthy are basically converting their time into wealth the most efficiently. So you got to have a business. You got to sell something where you can make many hundreds of thousands of dollars per hour. That's how you can become wealthy. You're not going to do it getting paid $20 an hour and working overtime at 1.5 times pay. It just doesn't work like that, in my opinion. Recession or not, Goldman Sachs expects the Fed to cut interest rates into Q2 of next year. Goldman may be right, but for the wrong reason. It won't be because inflation's moving toward the Fed's 2% target, but to help the federal government finance an exploding national debt. That's why they would do it. So according to CNBC, there are 275 million cars in the United States. 100 million are financed. Total amount financed is 1.5 trillion. Does this surprise you? I don't really know, guys. I have, at my house right now, we have 5 cars, and none of them are financed. They're all older vehicles. So I don't know. Does this surprise me? No, not really. And I think buying a new vehicle, it's just, I can't do it myself just because of the depreciation. I'd probably buy a used vehicle with low mileage. So coming on down to Peter, he says there are abundant signs of tightening and distress throughout the petroleum complex, particularly for refined products. This will spread further to crude in the coming weeks as very large top-line EIA oil draws on the 23rd and 30th will underscore the second half market imbalance. He is long. I get it. Druck and Miller bought CCJ in his 13F filings. Here, where is it? Somebody posted his filings down here. I guess not. Someone posted his filings. There's a bunch of shares in Camco. a whole bunch, like 869,000 or something like that. It's on like Donkey Kong. IEA's latest oil supply and demand balance. You can see a little bit of surpluses in 2022 with the great SPR releases. Then we've got the deficits coming in the second half of 23. Is there going to be a little bit of a surplus? Maybe, maybe not. And then back to deficits. Michael Burry, latest 13F filing is out. So this is Michael Burry's. Here's what caught my eye. 900 million SPY puts, 738 million QQQ puts. He bought Vital Energy, Generic, and Expedia. Now, if I look and open this, a couple of things. So he had some massive puts up here. Jesus. I scroll on down, look for some energy. VTLE is an energy. NEX, energy. He's got CRGY. He's got CRK as energy, Comstock Resources. And CMRE. Those are some of the positions that he has. Interesting. Corey writes, would you rather have a paid-off old car or a new car with debt? Okay, so she went kind of to the extreme here on the old car. And then she went to the extreme on a new car. Granted, this isn't a totally brand new car. But, you know, what I've done is I have an old car. I have no debt. The only debt I have is the mortgage, and I'm just going to leave that. So I would rather have an old car because that's what I've done. That's what I'm living. There's big COMEX silver inventory drawdowns are back. 1 million shares out of the vaults, should be 1 million ounces out of the vaults following drawdowns at the end of last week. Oil prices are climbing a wall of doubt and skepticism, huge deficits into the market into the second half. So get ready, guys. Here we go. It says, are rising interest rates bearish for gold, as many contend? Simple accounting with some logic and backed by actual history in this chart from McLeod Finance shows that that's not the case. And what he did is he took the 70s. The 70s was an expansionary phase of real estate, credit expansion, increasing interest rates and increasing gold price. We also had gold that started freely trading in 1970. So I don't know how much of an impact that had, and I don't know how that plays an impact to gold rising during that time frame along with rising interest rates. Maybe gold was so suppressed and so cheap that it raised, you know, it went up in that environment irrespective of an increasing or decreasing interest rate environment. But it did go up during that increasing interest rate environment. Eric says, if you reflect on the likely will and intent of HRH, ABS, and Saudi, then you may see where oil inventories and therefore the oil price are likely to go. Global oil inventories just hit a one-year low in terms of inventories. That's a pretty steep drop in global oil inventories. Kiwi says, recession, what recession? Hard to believe delinquencies are this low given where mortgage rates are. So breaking, seriously, U.S. mortgage delinquent loans, which are 90 days or more past due or in the process of foreclosure, fell to the lowest non-seasonally adjusted rate in 23 years at 1.61%. The forced selling is not out there. The delinquencies are not out there, at least not yet. Kevin says, this is going to lead to a cascading meltdown of the USA's economy. Rates will need to be slashed quickly when it breaks. And I think that is what makes the problem weird, is the economy is probably going to get into trouble when the rates go up. But the other problem is the rates are going up because they've got all of this debt they need to release. So are they going to do QE? Are they going to try to lower rates when the economy starts to tank? Are we just going to get higher rates, higher inflation with a bad economy, which is stagflation? I don't know. I mean, I kind of think it's all of the above. I think they're going to try to save the economy, and they might do QE, which is going to blow up the housing market to the upside because there's no foreclosures, there's no forced selling. And the spot that the Federal Reserve is in a tough spot. I don't know what the heck they're going to do. Burry just shorted. Agreed. Has anyone who turned 30 actually felt 30? Asking for a friend. What I'll say is, in my 20s, the 20s are amazing, guys. I love my 20s, man. Early 20s were fantastic. I felt a little bit of a hit around 27 years old, 26, 27. Like, you can't do those all-nighters and all that. I actually felt really good in my 30s. Like, early 30s is the strongest I've ever been. 33 was my peak year. Super strong, super healthy, could lift like an ox. It was amazing. I really liked my early 30s as well. I start feeling it kind of late 30s, early 40s. I just can't do what I used to. I can't lift. I don't have the stamina. I just don't have the grunt that I used to have. I can't go out and lift weights like I used to. There's no way. I can't sustain that intensity like I used to. Despite over a year of recession fears, oil demand is doing just fine. In fact, hard to do much better than highest ever in history. And this is the global oil demand that's coming back up, and it's highest ever in history. That's real cool. One says, how do you define bad debt? Bad debt is any debt that doesn't make you money or isn't against an asset that goes up in value. So bad debt is going into debt to buy a depreciating liability, a car, clothes, anything that you go into debt where it doesn't really go up. That is what I would consider to be bad debt. It would be crazy to turn down a 19% raise from a different company, right? I think it depends on the fit. I think it depends on your vision of your life. If they're going to offer a 19% raise and it's a direction you want to go in, then I would definitely do it because it's the direction you want to go in. If you want to go and you want to be a real estate agent and you get a 19% increase on the pay that you're doing today, which is being a builder of a product. Oh, I get 19% going over to this and do that. Well, it's not really getting you where you want to go. So I would say if it fits within the vision, definitely do it. If it doesn't fit within your vision, your life vision, then I wouldn't do it. I mean, I would say it's basically that simple. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel if you haven't. And yeah, that's all I've got for opinions. So we'll catch you next time. This is Finding Value.